In 2019, U.S. sanctions on PDVSA tightened dollar channels, and Venezuelan banks faced tougher screening on international oil payments. That shock hit your company through delayed wire transfers, failed cards, and payroll gaps when suppliers demanded prepayment confirmations. It happened because correspondent banks reduced risk, and compliance teams often automatically flagged Venezuela-linked names, ports, invoices, and counterparties. Caracas, Maracaibo, La Guaira, Puerto Cabello, and Valencia anchor this story, so visuals match Venezuela on screen for today's viewers. Venezuela's oil boom financed Caracas towers, Chacao offices, and bank lobbies, where importers paid vendors through daily dollar clearing. At Lake Maracaibo, refineries and pipelines fed container yards, cranes, and customs desks that once processed routine shipping documents smoothly. In Puerto Cabello, warehouses are filled with machinery, while port docks load cargo ships under predictable insurance, invoices, and bank transfers. Angel Falls, El Avila, and Los Roques look stunning, but do they protect your payment rail when risk flags appear? You are watching Tax and Borders, and this analysis explains context, turning points, friction points, scenarios, and risks for Venezuela today. When reserves shrank and inflation surged, the believer lost credibility, and pricing shifted toward the dollar, cash, and the exchange market. Power outages and network instability disrupted card terminals, forcing businesses to improvise, often relying on cash logistics for payroll, fuel, and inventory. Foreign banks and card networks have tightened controls, so even lawful Venezuelan invoices often trigger additional questions and slower approvals today. At Maiquetía Airport and La Guaira Port, manifests, end-user statements, and route details became essential for clearing shipments. One turning point was PDVSA's designation, which expanded sanctions screening to counterparties, oil references, shipping corridors, and related entities globally. Another turning point was correspondent de-risking, in which overseas banks restricted USD clearing and narrowed the routes connected to Venezuelan activity. A third turning point was the enhanced due diligence requirement, which demanded clearer ownership charts, source of funds evidence, and consistent business narratives. Can a business survive when onboarding resets, accounts are offboarded, and support tickets replace predictable settlement timelines everywhere without warning? Some banks remain connected through limited corridors, yet settlement speed deteriorates whenever policy shifts, or headlines raise risk suddenly again. Capital controls and exchange restrictions increased friction, and businesses relied on split payments, parallel markets, and a tighter documentation daily routine. Banking access has become uneven across institutions, regions, and seasons, creating operational planning risk for importers and service companies today. Trade documentation turned into oxygen. Invoices, HS codes, bills of lading, and end-user files decide whether containers move smoothly. If those documents are missing, demurrage fees increase, storage charges accrue, and customers experience delays that damage the reputation for months. Another friction point is identity volatility, where switching phones, IPs, or countries often triggers heightened verification for Venezuela-linked profiles. Another friction point is pass-through behavior, where round numbers and rapid outflows resemble layering without contracts and delivery proof. A Caracas service firm receives wire transfers labeled consulting, pays contractors quickly, and monitors the pattern without attached clear deliverables. A Valencia importer wires a supplier, but the bank halts payment because the counterparty's files are incomplete and ownership data are stale. A La Guaira container is held because the manifest lacks sufficient details, prompting questions from the carrier, insurer, and bank, and causing costly delays. Some founders reroute payments through third countries, but such detours appear evasive and often dramatically increase screening intensity for banks worldwide. Crypto rails can diversify settlement, yet exchanges apply geofencing and compliance controls, freezing Venezuela-linked on-ramps without warning. Does a nominee or friend's account reduce friction when banks screen beneficial owners, logins, and counterparties across multiple systems? Venezuela's story also includes borders, where Colombia crossings and the Orinoco corridor reflect daily shifts in trust and cash flows. In 2025, tensions over the Essequibo dispute with Guyana increased, adding political risk to regional corridors and payments for operators. Venezuelan naval actions near Guyana's oil operations drew warnings, raising the reputational risk for banks and insurers. U.S. officials publicly discussed consequences and options, and rhetoric alone can materially tighten compliance thresholds before formal rules change. In December 2025, U.S. authorities seized a tanker off the coast of Venezuela, signaling enforcement capacity and escalating headline risk for shipping. Headlines create a feedback loop. Risk scores rise, limits shrink, and compliance teams demand more substantial evidence for everyday transactions across the organization. In late 2025, U.S. Caribbean interdictions and clashes with suspected smugglers revived talk of escalation against Caracas in the media. Speculation about regime change pressure, even without formal action, leads banks to assume higher volatility and materially reduce Venezuelan exposure quickly. Maps of the Essequibo region and ExxonMobil's Guyana projects appear in briefings, turning borders into compliance flashpoints overnight today. When officials warn of consequences for attacks, compliance departments tighten sanction screening and often treat Venezuela corridors as unstable immediately. Remittances from Miami, Madrid, and Bogotá keep households afloat, but providers question origin stories when cash deposits spike suddenly today. Dollarization spreads in shops and taxis, yet merchants still face settlement holds because card processors avoid Venezuela's risk profile. Stablecoin usage rises for small transfers, but on-ramps still freeze accounts when geolocation, counterparties, or descriptors are often flagged as sensitive. Pseudo-ban supervision and political influence shape bank behavior, and rule changes can affect branches with little public explanation. Suppliers demand escrow, advance payment, or offshore settlement, so working capital drains faster when shipments sit in review longer. Airline routes and cargo insurance can change rapidly, and a single blocklist hit can reroute freight through longer corridors overnight. In Caracas, visible wealth contrasts with empty offices, and inequality fuels security costs that squeeze legitimate businesses' margins daily. So, Venezuela's problem is not scenery. It is compounded geopolitical, infrastructure, and banking risk moving faster than contracts today. Inside Caracas, bank branches, queues, cash scarcity, and policy uncertainty shape daily operations more than glossy office skylines for entrepreneurs. At the Maracaibo docks, importers plan for document-heavy shipments, expecting additional inspections and slower clearance due to routine sanctions screening today. In Chacao and Las Mercedes, businesses adapt by shortening settlement cycles, reducing leverage, and keeping conservative inventory buffers to survive. Tourism pockets still exist, including Los Roques and Canema, yet settlement friction limits scale for lawful service operators in practice. The core reality is uneven rails. One bank works today, another pauses tomorrow, and policy changes arrive abruptly for operators. Compliance behaves like underwriting. Institutions want precise control, clear purpose, clear counterparties, and repeatable transaction patterns before restoring full access. Unclear memos, mixed personal flows, and unreconciled deposits look unexplained. So reviewers extend holds or terminate relationships to de-risk. Can your cash conversion cycle withstand 2 weeks of held settlements while payroll, rent, and supplier invoices continue to accrue? Many exporters now expect pre-clearance with contracts, invoices, and delivery evidence attached to reduce back and forth with analysts. Insurance and shipping firms also tighten controls because dual-use goods and unusual routes often trigger escalations for cargo to Venezuela. In ports like Puerto Cabello, delays compound quickly, leading to storage fees, missed sales windows, and strained supplier relationships for months afterward. Currency reforms and redenominations change notes, but trust still depends on reserves, policy stability, and functional payment rails nationwide today. Some families store value in dollars, gold, or hard goods, yet provenance questions complicate later transfers and seriously complicate banking reviews. The political economy concentrates power, and shifting enforcement priorities can rapidly change what is tolerated within financial channels. Meanwhile, global databases flag Venezuela-linked names and entities so that screening can easily trip on similar spellings and false positives. Wildlife in the Llanos and the mountains near Mérida is beautiful, but risk is measured in liquidity and clearance time. When electricity fails, terminals fail, and infrastructure risk compounds compliance risk, especially for hospitals, fuel, logistics, and critical supply chains. Local businesses sometimes accept multi-currency payments, but reconciliation becomes more complex, increasing auditability demands from providers across banks. Shipping manifests, stamps, and end-user statements are your operational passport across borders. Banks and insurers here every day. Even with perfect paperwork, some corridors remain restricted, and counterparties refuse to provide exposure due to sanctions fears and shrinking compliance budgets. That is why entrepreneurs price risk, build buffers, and treat Venezuela as a high-friction jurisdiction, not as a myth in operations. The skyline metaphor matters. Towers can stand, but liquidity can disappear when correspondent links narrow, and approvals slow suddenly. Cargo ships can arrive at La Guaira, yet goods can stall if payments, insurance, or customs clearance break down suddenly. Venezuela's opportunities exist, but they require realistic expectations about delays, documentation, and the risk of sudden offboarding by banks abroad today. Operators there measure operational resilience, not just margins, because rails can sometimes fail quickly in practice without any illegal intent. Analysts focus on counterparties, descriptors, and routes because small details can trigger screening, holds, and re-verification across multiple providers. Processors monitor disputes and refunds closely because they expand reserves as volatility increases, especially for Venezuela-linked merchants today. Change events such as travel, device swaps, and volume spikes often push profiles into manual queues again for review without notice. The country's risk label means consistency as currency, repeatable patterns, identity signals, and coherent transaction stories for compliance teams. Caracas, Maracaibo, and Valencia still trade, yet every payment crosses a compliance border checkpoint in someone's system somewhere today. If this analysis was helpful, please comment on your industry and payment rails, and share any friction points you see with Venezuela right now. This content is educational only, not legal, tax, banking, or compliance advice, because policies change and facts vary by jurisdiction.